thank you for coming. We've had the AGMs. Paul has spoken a wee bit about what's happened over the last few years in terms of the investments that have been successful, the investments that have not been so successful. And what I think we're going to try to do now is just give you a bit more of a picture of how the portfolio looks today and the prospects for the portfolio going forward, rather than a more backward-looking appraisal. And once we've done that, questions and answers. But if you would like to ask questions during, I'm perfectly happy to take questions during, as I'm sure Paul is. So feel free to interrupt. And then we'll go into the portfolio company presentations, Crawshaw's and Accesso, two of our very promising businesses, and then a break, and then back for the Entrepreneurs Award. So this is my bit. What I'll really try to do here is just give you an overview for how the VCTs look and give you a feel for the typical kind of company in the VCT today, because we can't talk about every one, but maybe I can give you a feeling of the typical type of business that's in there. And this is obviously something we have to look at. This is what we call the style analysis, and this breaks down the portfolio, in this case Amati 2, there's a similar slide for Amati 1 next. This breaks down the portfolio into the classification of investment. Now, on the left-hand side, really, if you think about the risk profile of the types of businesses in the portfolio, the highest risk are on the left and the lowest risk are on the right. So the highest risk are unquoted shares and lowest risk on the right over there, cash. And it moves through these different categories. The different bars, the different coloured bars, the light grey bars are February 2014. So the light grey bars are how the portfolio looked in February 2014. The dark grey bars are how the portfolio looked in February 2015, so the end of the financial year we've just been discussing. And then the gold bars are the most up-to-date positions, so May 2015. And you can see this gives you an idea. I mean, this is only 18 months. But this really gives you an idea of how the portfolio has moved over that 18-month period. And what we're trying to show here is that in these very risky areas, such as unquoted shares, convertible loans and pref shares and unquoted companies, pre-profit equity holdings, listed equity holdings, you can see that the weighting in these categories over the last 18 months started to fall in all of these categories. And conversely, in this area here, which is the core of the portfolio, so this is profitable, what we call profitable growth companies, but companies that are capitalized at under 50 million, and then maturing small companies, those that are capitalized over 50 million, that started to grow. You could see that actually went down there, but over the piece, those are getting bigger. So what we can say here is that our exposure to the riskier end of the market is reducing, and at the same time our exposure to sort of the less risky end of the market, these more mature, more profitable companies, is increasing.
Douglas, can I ask,
yeah.
Is that a conscious choice, or is that actually because the corollary of that would be that the more risky ones have not done as well,
Yeah.
therefore as a proportion of the fund,
Yes.
you get less,
Yes.
and therefore it's not actually, say, if it's
Yeah.
the former, that's good, and if it's the latter, then it's an irrelevant chart.
Yes, it's good. It's a good question. It's both. So we've had, where we've had failures really over the last year or last 18 months, a lot of those failures have really been in this area. So that's naturally reduced that end of the portfolio. And then where we've had successes have been here, but also where we've been doing deals recently. So the two deals that Paul mentioned that we've done so far this year, PTSG and Bilby, they're both in this category here. So it's both, in answer to your question. It's two things. It's really, we have to hold, what we're really, under normal circumstances, what we're holding cash for, we tend to run the portfolio pretty fully invested. We'll always have a buffer of sorts to pay for dividends or expenses, whatever it is. The reason the cash balance has ticked up is really a function of the fact that this year we've only done 2 qualifying deals. If you look back to previous years, in the first half, or in the so if we're looking at the data to May. So in the first 5 months of 2014 and 2013, we were more active on the deal front. So we would have been consuming more cash. So as we've been realizing investments, we've been deploying that cash again at a slower pace. So this is the same thing for Amati VCT. I won't go through this, but it's the same idea, really. And I suppose the other thing that's worth saying here is that when you are making the tactical choice to shift from one area of focus to another, that's of course a very, very slow process, because you're dealing with, whilst we're dealing with predominantly listed companies that you can buy and sell on the market, the liquidity of some of these companies is pretty short. So you can't suddenly, and also you're operating within the VCT rules, so you can't wake up one morning and say, I want the portfolio to look like this. It's a very, very slow, gradual process of evolution. Now, this is to give you a feel for what I said at the beginning, the typical size of a business within the portfolio. And to do this, we looked at, I've taken these stats from the top 30 companies in the portfolio. And if you're thinking, well, is that representative of the portfolio as a whole? The top 30 businesses in Amati VCT1 represent 78% of the total value of the fund, and in Amati VCT2, 77%. So hopefully it's reasonably representative. Now, all the statistics here are weighted averages. And the reason I've used weighted average rather than a simple average is so that more emphasis is placed on the larger holdings and less on the smaller holdings. So I've weighted all of the market caps relative to their sizes within the portfolio. And what this tells us here is that the weighted average market cap of a company in Amati VCT is 125 million. In Amati VCT2, it's 130 million. Then if we strip out, you say, well, that includes your non-qualifying holdings as well. So if we strip out our non-qualifying holdings, that falls to 72 million and 81 million. So perhaps larger than you would expect to see in a VCT, but again, that's the reason for that is that because we're running AIM VCTs rather than generalist VCTs, we never have any pressure to exit holdings. So if we like a company and we like the long-term prospects for a company, we keep it. So we can run our winners, and often those winners turn out to be very big companies. And that's actually illustrated in the line below. Our largest qualifying holding by market cap is 240 million, and that is GB Group. And the smallest company is 3 million, so quite a broad range. That small company is smaller than we would ordinarily invest in. It was larger when we invest in it. That's one that didn't work out, so we're exiting that. One thing that's worth saying, actually, the bulk of our investment in that very small business was via a convertible loan. So we did lose money on that. We have lost money on the equity, but the bulk of our money was invested as a loan, and we're hopeful that we'll get that loan repaid. So that's the size of the businesses. This is the fundamentals. So what kind of revenues, what kind of profits are generated by the companies that you're invested in? And again, I've used weighted averages here. And these statistics are for qualifying companies only, because the problem is if we put our non-qualifying companies in, it would distort these figures, because our qualifying companies tend to be much bigger. Our non-qualifying companies tend to be much bigger. So this is our qualifying companies only. The weighted average revenues in both Amati VCT and Amati VCT2 are around about £30 million. And the weighted average EBITDA, so that's earnings or profit before interest, tax, depreciation and amortization, which is, as I'm sure you know, quite a good measure of the underlying profitability of a business. That's 21% in Amati VCT, 18% in Amati VCT2. That's, in my view, that's pretty good. We different industries will display different margin characteristics. Technology companies will tend to have higher margins. Something like a retail business will tend to have lower margins. But we're, as you would expect, we're quite tech heavy, software heavy in the portfolios. So that's definitely a driver behind those weighted average EBITDA margins. And then, are these companies profitable? Well, 24 of the top 30 companies in Amati VCT are profitable, and 26 of the top 30 companies in Amati VCT2 are profitable. And what about the balance sheets? Well, net cash, 23 out of 30 companies in Amati VCT have net cash, and 21 out of 30 companies in Amati VCT2 have net cash. So some of these companies may have debt, but if they have net cash, they have more cash than debt. And those 7 companies in Amati VCT that have net debt positions, and 9 companies in Amati VCT2 that have net debt positions, tend to have quite prudent positions, because as a rule we won't invest in small companies that are very highly geared. So those are just coming back, those are the size characteristics, those are the fundamentals. So we're looking at, on first glance, I think we're looking at a portfolio that's delivering pretty good revenues, good profits, good profit margins with pretty strong balance sheets. So kind of by definition, you'd say these look like quite good companies. So the next question is, are these very expensive companies? And to answer that, we looked at the weighted average PE ratios. Now, there's a big caveat here, because what I've done to get down to something that I think is meaningful, I've stripped out, again, the non-qualifying holdings, but I've stripped out the loss makers as well, and I've stripped out any companies where I don't think the forecast is particularly reliable. So that takes the 30 companies down to 18 companies for this sample, for these purposes. And you can see that the weighted average PE ratio is about 18 times in both portfolios. That really needs to be put into context, and I think there are 2 ways of doing that. And the first way is to look at the growth rates, the earnings growth rates of the portfolios. And the second way is to look at those PEs versus the market. So question number 1, are our companies growing faster or slower than the market? And are those PE ratios justifiable by the growth rates? And question number 2, how do those pegs stack up against the market? And sorry, I should say a peg is the price earnings growth rate. So you take the PE ratio and you divide that PE ratio by the earnings growth rate. And normally, what you would say, the sort of conventional wisdom would say that any company that's on a PEG ratio of less than 1 looks like pretty good value. Anything above 2 looks pretty expensive. So you can see in our portfolio, these companies are hovering around about 1. So PE ratios of 18, weighted average earnings per share growth, 16 in Amati 1, 21 in Amati 2. So that gives 1.1 times PEG for Amati VCT and 0.9 for Amati 2. So on that basis, I don't think those companies are looking particularly expensive. So somebody might look at the top line, say 18 times isn't that expensive, but I think in the context of the growth rates, that's not too bad. And then, as I said, we can compare our price earnings growth rates against the market. And you can see here, this is data from Peel Hunt. Again, they exclude loss makers. So these are the different indices here. This is FTSE 100, 250 small cap, and FTSE AIM all share. You can see for FTSE 100, forward PE ratio is 15 and no earnings growth. That's across the board. Clearly, there are companies in there growing, but there are plenty of companies in there that are with declining earnings. FTSE 250 is even more expensive, 16 times. It does have earnings growth, but not a great deal, so a very high PEG ratio at the moment. So some people would argue that the FTSE 250 looks very expensive on that basis. And the FTSE small cap, you can't derive a PEG because the earnings are negative. AIM all share displays quite similar characteristics to our portfolio, but we never really trust the data in the AIM all share, so I wouldn't place too much weight on that. So company fundamentals look pretty good, and I think the valuation looks okay as well. So just before handing over to Paul, I think that you can hopefully you've seen what you've seen is that the portfolios are starting to mature more. from that chart with the bars that showed how it's evolving. And I think that the data that I've shown you today and the exercises that we do to look at the portfolio and the characteristics of the portfolio give us confidence in the outlook. It also gives us a feeling that what we really have to focus on and what we would like to focus on is the more profitable, more cash generative businesses, because those have been the types of businesses that have worked well for us and seem to work pretty well on AIM. Now that's not, you can't just do those exclusively. As I said earlier, we only need to do 3 or 4 deals a year. We're not excluding entirely something that perhaps doesn't display those characteristics, but certainly the focus will remain on these more mature, more cash generative companies.